Asset finance team in an investment bank. Exploring the key role of asset finance team. Presentation overview. Asset finance overview. Asset finance is a type of financing used to acquire assets such as machinery, vehicles, and equipment. It is important for businesses as it allows them to free up capital and invest in growth. Types of asset financing. Asset financing can be done through leasing, hire purchase, and project finance. Each method has its own benefits and drawbacks, and it is important to choose the right one based on the needs of the business. Role of asset finance team. The asset finance team in an investment bank plays a crucial role in advising clients on the best way to structure their financing and manage their assets. Their responsibilities include risk assessment, due diligence, and negotiating terms with lenders. Introduction to asset finance. What is asset finance? Asset finance is a type of financing that allows businesses to acquire assets such as machinery, equipment, or vehicles without having to pay the full amount upfront. This helps businesses to preserve their capital and free up cash flow for other purposes. Benefits of asset financing. Asset financing offers several benefits to businesses, including tax advantages, improved cash flow, and the ability to acquire higher quality assets that can help businesses to improve productivity and expand their operations. What is asset finance? Asset finance is a type of financing that allows businesses to acquire assets without having to pay the full amount upfront. The assets can include machinery, equipment, or vehicles, and the financing can be customized to the needs of the business. Why is asset finance important? Access to assets. Asset finance provides businesses with the ability to acquire assets such as machinery, equipment, and vehicles that they may not be able to afford otherwise, allowing them to grow and expand their operations. Flexible financing. Asset finance provides businesses with the flexibility to structure their financing according to their cash flow and business needs, allowing them to better manage their financial resources. Types of asset financing. Leasing. Leasing is a type of asset financing where the business rents the asset from the lender for a fixed period of time. This type of financing is suitable for businesses that need to use the asset for a short period of time or cannot afford to purchase the asset outright. Hire purchase. Hire purchase is a type of asset financing where the business pays for the asset in installments over a fixed period of time. The business does not own the asset until all payments have been made. This type of financing is suitable for businesses that need to use the asset for a longer period of time. Project finance. Project finance is a type of asset financing where the lender provides funding for a specific project or investment. The business uses the funds to purchase the asset, and the lender receives a share of the profits generated by the project. This type of financing is suitable for businesses that need to finance large projects or investments. Leasing. Types of leases. There are two main types of leases, operating leases and finance leases. Operating leases are short-term leases that allow businesses to rent assets without committing to a long-term obligation. Finance leases are long-term leases that allow businesses to acquire assets without tying up their cash flow. Advantages of leasing. Leasing allows businesses to acquire assets without tying up their cash flow. It also allows businesses to keep pace with technology by enabling them to upgrade to newer assets at the end of the lease term. Additionally, leases may provide tax benefits to businesses. Disadvantages of leasing. Leasing may be more expensive in the long run compared to purchasing assets outright. Additionally, businesses may be subject to penalties if they terminate leases early or if they go over their allotted usage of the leased asset. Hire purchase. Hire purchase allows businesses to acquire assets without having to pay the full amount upfront. Instead, payments are made over a fixed period of time, making it a flexible financing option for businesses with limited resources. Project finance, securing funding. Project finance allows businesses to secure funding for large-scale projects without tying up their cash flow or collateral. Funding is often raised through a consortium of banks and investors who are willing to invest in the project. Repayment through project revenue. Project finance is repaid through the revenue generated by the project. This means that the project itself acts as collateral, allowing businesses to secure funding without risking their assets or creditworthiness. Large-scale projects. Project finance allows businesses to undertake large-scale projects that may not be possible with traditional financing options. This is because project finance allows businesses to secure funding for specific projects and does not tie up their cash flow or collateral. Role of asset finance team in an investment bank. Identifying potential clients. Asset finance team plays a critical role in identifying potential clients for investment banking deals. They conduct market research and identify companies that would benefit from investment banking services. Conducting due diligence. The asset finance team is responsible for conducting due diligence on potential clients, including analyzing financial statements, assessing creditworthiness, and conducting background checks. Structuring deals. The asset finance team is responsible for structuring investment banking deals, including negotiating deal terms, valuing assets, and determining the appropriate financing structure. Managing risks. The asset finance team is responsible for managing risks associated with the investment banking deals, including credit risk, market risk, and operational risk. Identifying potential clients. Asset finance team analyzes the market and identifies businesses in need of financing for their assets. They use various tools and techniques to research and identify potential clients. Conducting due diligence. The asset finance team conducts due diligence to assess the risk involved in financing the assets. This involves analyzing the financial health of the business, evaluating the assets being financed, and assessing the regulatory environment. Structuring deals, customized financing solutions. Asset finance team structures financing deals customized for each client to suit their specific needs and requirements. They offer a range of financing options from cash flow lending to mezzanine financing that can be tailored to meet the client's business needs. Repayment terms. Repayment terms are an important aspect of structured financing deals. Asset finance teams evaluate the client's repayment capabilities and design the repayment terms accordingly. This may include periodic payments, balloon payments, or a combination of both. Interest rates. Asset finance teams offer competitive interest rates to ensure that clients receive the best possible financing deal. They offer a range of interest rate options, including fixed and variable rates that can be customized to suit the client's needs. Negotiating terms. The asset finance team is responsible for negotiating the terms of the financing deal with the client. This involves ensuring that the terms are favorable to both the bank and the client. Key items that are negotiated include interest rate, repayment terms, and security. Managing risks. The asset finance team is responsible for managing risks associated with financing assets. This involves monitoring the financial health of the clients, assessing the risks associated with the assets being financed, and ensuring that the bank has adequate security for the financing. Conclusion. Asset finance is a key division within an investment bank and plays a crucial role in identifying potential clients, conducting due diligence, structuring deals, negotiating terms, and managing risks, ensuring businesses have the financing they need to grow and expand. Thank you.